There are the opening bells on Wall Street on this summer Tuesday. I'm Yahoo Finance Executive Editor Brian Sozzi, and this is Opening Bid. Here on Opening Bid, we bring you the investing analysis you need to know to unleash the power of your portfolio. We're digging to what's really moving stocks, giving you the unbeatable context to make decisions with all that money in your portfolio. Let's see what's hot in the markets right off the jump here. Yahoo Finance senior reporter Ali Canal is here from the NASDAQ in Times Square. Ali.
Hi, Brian. Yeah, so we're seeing a bit of a mixed picture at the open here. We have the Dow trading just below the flat line, off about 0.1%. The NASDAQ Composite, though, that tech-heavy index, rebounding from some of the losses that we saw in yesterday's trade. We were up about 0.3%, and the S&P 500 also hugging the flat line there. Now, Treasury yields, that's something I have my eye on this morning because the 10-year yield, that is trading above 4.4%. So that is a critical level to watch as we've seen this step down in yields over the past month or so. Remember, around Trump's Liberation Day tariff announcements, we saw a significant spike in yields, and that led to some pressure on the equity side of the equation. So I'm going to continue to watch yields to see how they can react to some of these trade and tariff headlines, because we know that that could potentially be a headwind to stocks there. I also want to take a look at what we're seeing under the hood of the NASDAQ 100. And like I just mentioned, with the tech recovering, we have NVIDIA up around 0.7%, Alphabet up around 0.6%, Amazon, which just started Prime Day today, that is also in the green, along with Broadcom and Meta, and even Tesla, which we know saw about a 7% decline yesterday on the heels of Elon Musk announcing a third political party that he wanted to start. Investors largely looking at that as a distraction. That is up today around 1%. But I also want to take a look at Palantir. Now, we're seeing some losses today, but yesterday it was one of the biggest gainers amid the sell-off. We saw the stock close around 4% higher. Then if we take a look at it year to date, I mean, this is just ripping right here, up over 80%. Palantir was actually the #1 stock in the S&P 500 for the first 6 months of the year. Remember, Brian, when we used to call this a meme stock? Well, strategists are now telling me that you cannot consider this a meme stock any longer. It is an AI play. It is a play when it comes to government defense spending. So it seems like there's a lot of momentum here behind this trade for Palantir. So we'll have to see how this stock continues to trade.
Yeah, good call out there, Ali. Of course, Palantir makes real things and does real things, unlike meme stock GameStop. See you soon. We're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what I'm watching. Number one, stocks hit the snooze button as President Trump dials back up his trade war with the rest of the world. Talk about yet another sign of investor complacency to future economic risks. But there should be no snoozing at all on what Trump does on tariffs. Could have direct implications on Fed policy and corporate profits this year. Number two, it's Amazon Prime Day, or at least day one of a 4-day summer shopping blitz on the retailer's website. In typical Amazon Prime Day fashion, it has big deals out on coffee makers, TVs, and vacuums. Oddly, though, Amazon stock isn't sharing in the Prime Day or Prime Week fun. Number three, taking a bite out of Apple's struggling AI team, Meta has reportedly poached Apple's head of AI models, Ruming Peng, handing out millions of dollars to land him as part of a Mark Zuckerberg AI recruiting spree. The move comes as Apple tries to convince a skeptical Wall Street that it will have a place in all things in AI. All right, let's bring in our roundtable here. Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist, alongside Yahoo Finance's senior reporter Ali Canal, and tech editor Dan Howley making his opening bid debut. Good to see you all. Gargi, let me start with you here, because I mentioned at the top, this market is snoozing at the latest on tariffs. I didn't think that would be the move off of renewed trade war fears. Why is the market not moving as much as you would think off of this latest bout of news?
Sure. Good morning, everyone. It's great to be here. So a couple of points. Why is the market perhaps not as excited, as volatile as we would have otherwise expected? First of all, I think that there are a couple of other drivers in the markets. Of course, you talked about a few of them. The biggest one that we perhaps haven't talked about yet is the advent of earnings season that's about to be upon us starting next week. And look, I think that after the incredible earnings season, after the incredible Q1 earnings seasons, expectations are low. So expecting about, call it a 6% earning growth for Q2. And within that, many expecting certain areas such as tech, software, particularly AI names, of course, expecting to beat, I think that's something that investors are keeping in mind. The second, I would say, is just around renewed expectation of Fed rate cuts perhaps being moved up a little bit. So to the extent that many were not expecting any rate cuts till the end of the year or none at all, I think everyone's getting their minds around the fact that we may get perhaps even 2 rate cuts this year. That will, at the end of the day, be good for discounting. So that's another thing. And then finally, I'd say that we've learned over and over again that sometimes some of the tariff news, tariff risks are, after all, just temporary. This might be viewed as another sort of negotiation tactic. I think the market is relying upon that just a little bit at the moment.
Dan, let me get over to you because Gargi was talking a little bit about earnings. I look at Goldman Sachs lifted its S&P target yesterday. One of their key planks in that theme was investors would look past any earnings weakness. Heard the same out of B of A's Savita Subramanian this morning when she lifted her S&P. But I look at what we could see in tech in terms of earnings, Dan. It's not exactly going to be great. I mean, you had Samsung out here warning today. Apple might be under concern because of its exposure to China. What are you seeing?
Yeah, I mean, the thing here with tariffs and Apple and this kind of announcement is, I talked to the ITC. They say that the new tariff announcements have nothing to do with the People's Republic of China. They are just left as is from that May 12th order that was signed between the two countries. So this isn't going to impact them. However, there's plenty of tech companies in the other countries that received those letters, as well as those that could be impacted by the reintroduction, or I guess the final introduction of tariffs if they do go into effect August 1st. So, when you look at something like an Apple, they're already banking on, billions of dollars in hits to their bottom line for the coming quarter. And so now one of the experts that I had spoken to, Gene Munster over at Deepwater Asset Management, said, look, now we have to start looking at the December quarter as well, because if anything does happen, if anything does change with regards to China or any of these other major supply chain countries, that would start to be then reflected in the December quarter. And so that's going to be a major time for Apple. It's also that December quarter when we see the first signs of when their new iPhone goes on sale. So, for tech more broadly, as you said with Samsung, they're struggling with AI. They're struggling to get the revenue there. And so, I think more broadly, it basically resets where tech was back in April to that kind of, left in this kind of limbo situation.
Gargi, let me get back to you real quick. There looks to be this view on the street that earnings that will start in a few weeks, we'll get it kicking off with the banks, but even industrials, that everything will be fine. Companies will come out here, beat on sales, beat on earnings, maybe reaffirm guidance or even give guidance that they didn't give 3 months ago. Is that the wrong move? It can't possibly be that perfect out there.
No, you're absolutely right. It can't possibly be perfect. And I think any kind of expectation that the impacts of tariffs are just going to vanish in thin air, I think is a little too optimistic. So, for example, I mean, obviously we are, learning about the new tariffs on the 14 countries now, and we don't know where those will land yet. But we already know that as of right now, we're still looking at approximately a 15-ish% tariff rate, which is obviously significantly higher than the 3% from last year. Where will that go? We haven't seen it come through into inflation yet. We haven't seen that affect margins yet. There's going to be a combination of those two that is going to play out in the next couple of weeks, months, years. I think so far, the fact that there was inventory buildup has perhaps saved us a little bit. And I think that's why we need to be really thoughtful about where in the market you want to be investing in the quarters and months ahead. Can equity markets broadly go higher? Sure, maybe. But I think where you pick your spots is really careful. And we've obviously talked a little bit about the AI trade. We're thinking about investing actively, even within the AI theme, because given these tariff news that's going to continue to play out over the next few months, we think there's going to be winners and losers within the space. And we think the BlackRock AI and Tech Fund, BAI, is a really great way of doing that. Another point that I do want to mention, and I talked about this earlier around inflation as well as margin. We talked about equities, but let's talk about inflation a little bit. If we look back at the last couple of prints on CPI, they've certainly been very welcomed by the market. But at the same time, there is still expectations of inflation continuing to remain a little bit sticky, and especially if these new tariffs come through. Allocating to inflation-linked space with real rates being, especially in the very long end of the curve, going back to levels we haven't seen in decades. We think inflation-linked bonds, things like STIP and TIP, can be a really good addition in your portfolio right now.
Let's do some rapid-fire analysis. Al, let me get over to you. This is Amazon Prime Day, or as Julie Hyman reminded me at the top of the show, maybe it's Amazon Prime Week. Now, you mentioned Palantir a couple of minutes ago. This stock has been ripping higher. What Amazon is not ripping higher into Prime Day. What's the vibe there?
Yeah, Amazon has certainly struggled, especially compared to the other Magnificent Seven names there. You know, I think this is a consumer story as well. And what we see from Prime Day, we had Adobe numbers come out that showed another strong year. But whatever those actual numbers are from Amazon, I think that's going to tell a particular story when it comes to the consumer. Because the biggest risks here for this economy, for this market, is if the consumer stops spending. We've heard concerns about their financial situation. We've seen some cracks in the data. The soft data has been a little bearish, although that's turning over the past few months, but that hasn't materialized in the hard data. So if that happens, that is the crack that we could see that could really, you know, I guess I want to keep the analogy here, break the river and we could fall into the water. So that's something that I have my eye on, especially with a company like Amazon that has a lot of touch points with the consumer and is also exposed to some of these tariff threats. But I think what Gargi was mentioning too, but just about how we don't know how tariffs are going to work their way through the system is an interesting one. And it's something that Goldman Sachs brought up in their S&P 500 upgrade. Analyst there, David Costin, said that recent inflation data and corporate surveys indicate less tariff pass-through so far than we expected. So if that changes materially and we see that impact the consumer and they stop spending, or that inflation uptick really hits their wallets, that's going to be a key concern here.
Dan, I want you to drop the mic here for our top of the show here. Apple reportedly losing a key AI person to Meta. This isn't good from the standpoint. Apple's still trying to convince the street it will have a place in the AI universe to such an extent that it will power its earnings for the next decade.
Yeah, I mean, look, it just goes from worse to, I guess, worser for Apple when it comes to AI here. I mean, really, they're struggling to get their own foundation models out the door. Now the head of their foundation model division is literally out the door, going to Meta. You know, this is all part of Meta's kind of spending spree, getting its AI chops up to snuff. Mark Zuckerberg not happy with where it is now. This is part of that plan. And I mean, look, if you look at something like Apple, they had to do things like pull back advertisements for Apple Intelligence, which came out last year, right? We were supposed to have had it by WWDC this year. That passed last month. And so obviously losing someone like this in Apple's key divisions makes it look like they just really don't have it going on in what big tech expects to be kind of the next big thing. So, I mean, Apple needs to make some serious moves, whether that is, you know, buying Perplexity or something like that. You know, it remains to be seen, but they need to make some kind of big move at this point.
Yeah, well, Tim Cook is taking photos with celebrities for F1. Good to see Zuck out there, water skiing? He posted on Insta and stealing some of Apple's talent. I appreciate his ruthlessness. Coming up, we'll have our stock of the day. Your clue, this company's very future is dependent on the futures of NVIDIA and Microsoft. You really should get this. Welcome back to Opening Bid. Checking in on the markets in this early going. Seeing some muted action across the board. Dow slightly in the red. The S&P 500 and NASDAQ toggling in between the green. NASDAQ looks like it is leading the way by just a little bit. All right, now let's fire up our stock of the day. That is CoreWeave. One of the hottest tech names of 2025 is spending $9 billion of its stock to buy rival Core Scientific. The deal is expected to give CoreWeave access to more data centers and save it $10 billion through 2032, as it won't have to pay Core Scientific to access its computing power. But Wall Street is mixed at best on this deal. D.A. Davidson tech analyst Gil Loria said the transaction is, quote, financial engineering on the part of CoreWeave. He maintained an underperform rating on the stock, or the equivalent of a sell. Citi analyst Tyler Radke opened a downside catalyst watch on CoreWeave today, citing concern about stock sales by insiders once the IPO lockup period expires in September. Jumping into the Yahoo Finance platform, you can see the aggressive expectations investors have built into CoreWeave's valuation since its March IPO. Seeing multiples like this is serious hopium on all things AI. Really, premium multiples across the board for CoreWeave. My roundtable is here to weigh in. BlackRock's Gargi Chaudhuri, Yahoo Finance's Ali Canal, and our tech editor, Dan Howley. So before I set this up, I want to set this up with some of my concern on this team, on this deal. One, or just with CoreWeave, I should say, a lot of AI expectations have been built into CoreWeave. That's number one. You also have, I just don't like when all stock transaction deals happen. I think it's a management team potentially overvaluing their stock. A lot of high hope on IPOs. And the IPO lockup period is a big deal. This lockup period ends in September. You could see a large slug of stocks sold, notably by insiders. And Dan, this stock has increased almost 4 times since the March IPO. This deal is being looked at maybe mixed at best. This is a lot of money for CoreWeave to be handing out here.
Yeah, I think a lot of this, as you kind of said, is the kind of AI hopium kind of aspect of it, and everybody kind of banking on AI as being the truly next big thing in tech. And look, we're still way too early to know if that actually comes out, right? It's certainly been a technology that's been transformative in the small amount of time that we've had with it. Don't forget, OpenAI and ChatGPT was 2022. That was that moment.
Feels like yesterday, Dan.
Yeah, it does. But I think for Wall Street, they see this and they go, "Ooh, we got a pure play here when it comes to offering data centers, offering the kind of compute that companies are looking towards, especially companies that don't necessarily want to build on-prem or otherwise known as on-premises data center capabilities." And so that's kind of the play here. I think the bigger question, though, is, well, why wouldn't they just go to Microsoft, or why wouldn't they just go to Google? And will Microsoft and Google use CoreWeave or continue to use CoreWeave? I think it's still very much up in the air at this point. But as you say, I do think a lot of this comes down to AI is everything. Everybody has to go whole hog into AI. I think we'll find out if it ends up truly washing out, though.
Gargi, let me get over to you because I think you're well placed to weigh in on this one. The price to sales ratio on CoreWeave, 27.4 times trailing. Price to book, 25 times trailing. And look, CoreWeave's not alone. I mean, these AI trades have valuations well above the market. I think about Palantir right off the jump. Is the AI trade overvalued?
Absolutely. And this is a question that comes up quite a bit from our clients as well. And I'd point to 2 things here. The first one is that, sure, there certainly are names within the AI space that will not live up to expectations, right? Where we may not see all of the promise of CapEx actually turn into revenue. But then there are certain names that will. And this is exactly why active management within the AI space is really important. So that's number one. The second that I'd say, and I think this is something that we learned over the last 3 months or so, I'd say especially after the DeepSeek scare, which we are old enough to remember, I think that what we saw was continuous CapEx that happened through the course of the last 6 months, continuous innovation, continuous spending, and the numbers were absolutely mind-boggling. And I think that is worth something if we look at how we all do our day-to-day work with AI today versus just even 6 months ago. That is productivity, that is efficiency. And to the other speaker's point earlier, AI may not be everything. It certainly shouldn't be 100% of your portfolio. But at the same time, if you don't have a sliver of your portfolio allocated to AI equities that may be managed in an active manner, I think you are missing out in the largest growing areas of the market. And I think that point is important. The 27 to 44% earnings growth that we saw across the largest 7 or 8 AI companies, that's meaningful and significantly above the 12% earnings that we saw for the entire S&P.
Good points there, Gargi. All right, I want to bring up our question of the day. It's a simple question, or at least I think I wrote this up, with answers that all tie back to Federal Reserve policy. Where are the economic fireworks? And Gargi, let me go back to you here because in about a week or two, maybe about 2 weeks, we're going to start to get a lot of the June inflation data. Of course, there's always a month lag. And that could show a pickup in inflation. That's a general view on the street. If that does happen, what will happen to the outlook for interest rates? Because the argument could be made, this market is trading at record highs because of views that we might get 2 rate cuts this year.
I'd sort of say that we're trading at record highs, not just because of expectations of rate cuts, but actually because of what we've seen in earnings and the expectations of earnings being at around, call it 7 to 8% for the entirety of 2025, perhaps even 2026. So it is twofold there. But coming back to your question of the week around, sort of economic fireworks, I think all eyes staying on inflation is really important. And this is also why I think adding some inflation hedging into your portfolio makes a tremendous amount of sense. So whether it's something like gold that you want to add in your portfolio, whether it's inflation-linked bonds that you want to be adding in your portfolio, or whether it's just areas of the equity market that are more susceptible to do well when inflation picks up ever so slightly, we think that makes a lot of sense. Now, coming to the second part of your question, if there is a pickup in inflation, what does that mean for the reaction function of the Fed? Look, I think Chair Powell has been really clear here in that they will only act when the data determines they do so. Now, we've obviously heard from a couple of other players within the FOMC that they're a little bit more dovish. They expect to cut rates a little bit sooner. But I think that the question of labor market strength or the lack of labor market strength, as well as inflation stickiness, remains really, really meaningful here. Why we're getting rate cuts is more important than how many rate cuts we get. So if we're getting rate cuts because inflation's here, sticky, but not meaningfully picking up, I think that's really good for the equity market. If we're getting rate cuts because the labor market actually has a massive slowdown here, I think that's when the equity market starts caring just a little bit more.
Ali, last word to you. I loved what the Morgan Stanley team had to say on this week. Maybe we just don't get any rate cuts this year.
Yeah. I don't necessarily disagree here, Brian, to Gargi's point. If you're getting rate cuts for bad news, that is a problem for the equity market. Now, Morgan Stanley economist Michael Gapin, he talked about the immigration part of the equation, and he's been hot on this for a bit now and saying that's been a bit underestimated in the sense that it's keeping the unemployment rate unofficially low while job losses are happening underneath the surface. So when we talk about some cracks forming in the labor market, that is potentially one of those things. So in terms of fireworks, I think it might come in August rather than July, because August 1st, we have that trade deadline extension. If history is any indication, potentially we could get another extension at that point. And August is also Jackson Hole. And we remember a few years ago, Jerome Powell gave that very hawkish speech at Jackson Hole, which sent equities into a tailspin. And then we went on that aggressive rate hiking cycle there for the Fed. So I do think August could have some volatility.
Best roundtable of the week. A big thank you to my contributors. Appreciate it. All right, the trading days are underway, and like I always say, every second matters. What you do right now can determine your financial future. So here's the one forward-looking indicator you need to watch for the rest of the trading session. That is, pay careful attention to how this week's earnings reporters in Delta, Levi's, and Conagra trade into their respected earnings releases. Remember, the economy has slowed and tariff headwinds both raise the risk of earnings guidance shortfalls. If these stocks trade higher into their numbers, any negative surprises could be treated very harshly by this FOMO market. Coming up, Yahoo Finance's Market Catalyst, we bring you the news behind the market moves for the trading day. Do stick around.